Section 22, Seller Credits and Concessions. Who is really paying what? The seller is giving us 10,000, so we get 10,000, right? Carlos is reviewing the final transaction figures one more time. The purchase contract shows that the seller agreed to provide a $10,000 credit toward allowable buyer costs. Carlos smiles. That's basically 10 grand the seller is giving us. Sarah pauses. It's a valuable concession, but let's make sure we're describing it correctly. This is where agents can accidentally turn a good negotiation into a misunderstanding. A seller credit can provide significant value to a buyer, but it is not necessarily a $10,000 check the buyer gets to put in a pocket at closing. The contract creates the agreement. Let's start with the real estate side. During negotiations, Sarah and the listing agent worked out a seller contribution toward Emily and Carlos's allowable costs. The parties agreed. The agreement was documented. That's the contractual piece. But Emily and Carlos are financing the purchase. That means another set of requirements may affect how the concession is used. The lender and applicable loan program may establish limitations on seller or interested party contributions and on which costs can be paid. That's why Sarah shouldn't stop at the seller agreed, so we're done. The loan still matters. Imagine Sarah negotiates a very large seller credit. She calls Carlos and says, I got you $20,000 toward closing costs. Carlos is thrilled. Then Jason reviews the agreement and says, under this loan structure, the buyer cannot use the concession exactly the way you're describing it. Now everyone is frustrated. Carlos says, Sarah promised us $20,000. The seller says, I already agreed to the credit. Sarah says, but it's in the contract. The contract matters. So do the financing requirements. This is why an experienced agent asks the lender about the proposed structure before making promises about what the buyer will actually receive from it. Different loan programs can mean different rules. Not every buyer has the same mortgage. Emily and Carlos might use conventional financing. Another buyer may use FHA financing. Another may use VA financing. Each program can have its own requirements concerning seller concessions or interested party contributions. Those requirements can also depend on the transaction and loan structure. Sarah does not need to memorize every contribution limit for every mortgage product. In fact, relying on memory can create problems because program requirements can change. The professional approach is, Jason, we're considering asking for this seller concession. Can you confirm whether the buyer can use it under the proposed loan? That's a smart agent question. Seller credits can reduce cash to close. Why do buyers like seller credits? Because allowable seller-paid costs can reduce the amount of money the buyer needs to bring to closing. Remember our earlier discussion about cash to close. The buyer may have a down payment, loan costs, prepaids, escrow deposits, government charges, and other expenses. A properly structured seller credit may offset certain allowable costs. For Emily and Carlos, that could preserve some of their available cash. But again, Sarah shouldn't calculate exactly how the lender will apply the credit. Jason and Maria will handle the applicable financing and settlement calculations. What happens to the unused credit? Here's a common closing week problem. Suppose the contract provides up to a $10,000 seller credit toward allowable buyer costs. At closing, only $7,800 can actually be applied. Carlos says, great, just give us the remaining $2,200. Not necessarily. A seller credit generally does not mean the buyer automatically receives unused funds as cash. The contract language, lender requirements, loan program, and actual allowable costs matter. Sarah should never promise, whatever you don't use, you'll get back. That statement could be completely wrong. This is why wording matters. Agents should also pay attention to how concessions are written. A vague statement such as, seller gives buyer $10,000 can create unnecessary questions. For what? Closing costs? Prepaids? A specific repair-related concession? Another permitted purpose? The form language and applicable contract documents should be used carefully. Sarah should follow brokerage guidance and current Arizona forms rather than inventing language that creates ambiguity. Then the seller asks a question. Now let's move to the listing side. The seller sees the closing disclosure and says, why am I paying the buyer's costs? I thought they were getting their own loan. The listing agent should be able to explain the real estate agreement. The seller agreed to the concession as part of the negotiated transaction. Maybe it helped preserve the purchase price. Maybe the inspection produced a concern. Maybe it made the buyer's offer more workable. Seller concessions are negotiation tools. They're not automatically good or bad. The important question is whether the seller understands what was agreed to and whether the settlement figures accurately reflect it. Don't hide concessions from the lender. Here's where things can become serious. Imagine Sarah and the listing agent agree. Let's just give Carlos $5,000 after closing, instead of putting it in the contract. That way the lender doesn't have to know. No. A side agreement designed to conceal a financial concession from the lender creates serious problems. Material financial arrangements connected with the transaction should be accurately documented and disclosed to the appropriate parties. An agent should never help structure a secret payment to avoid lender review. That's not clever negotiation. That's risk. RESPA can enter the conversation too. Seller concessions themselves are not the same thing as a prohibited referral fee. But settlement service relationships can raise separate RESPA concerns. Suppose an agent says, "Use this title company and I'll get part of the fee back." Now we may have a very different federal issue involving compensation for settlement service referrals. RESPA Section 8 and Regulation X restrict kickbacks, referral fees, and certain unearned fee arrangements involving settlement services. This is why agents need to separate legitimate negotiated transaction credits from improper referral compensation. What would you do? Imagine you're Sarah. The seller agreed to a $12,000 credit. 3 days before consummation, Jason tells you the buyer can only use $9,500 under the current loan and closing cost structure. What do? You don't promise Carlos the other $2,500 in cash. You don't secretly arrange for the seller to pay it after closing. You communicate with the lender, escrow professional, your client, and your broker as appropriate. Then determine whether the parties want or are able to address the remaining contractual issue through a properly documented transaction change. Broker tip: verify before you negotiate. Big seller concessions can be powerful. They can help buyers manage closing costs and can help transactions come together. But a concession that the buyer cannot use as intended isn't much of a victory. When the amount is significant, coordinate with the lender before finalizing the structure whenever possible. And never promise a buyer you're getting that money. Say instead, "Let's make sure the lender confirms how the credit can be applied." Emily and Carlos now understand their seller credit. But there are other numbers on the closing disclosure that can confuse both buyers and sellers, especially taxes, HOA amounts, prepaid expenses, and prorations. Those numbers may look small compared with the purchase price, but when they're wrong, someone can end up paying expenses that belong to somebody else. That's where we're going next. Online discussion 1. Sarah negotiates a $15,000 seller credit and immediately tells Carlos that he will receive the entire $15,000 benefit at closing. What is the problem? Answer: the purchase contract can establish the seller's agreement to provide a credit, but the buyer's loan program and lender requirements may affect how much of the concession can be used and which costs it may cover. Sarah should coordinate with the lender before guaranteeing the financial result of the concession. 2. Only $8,000 of a $10,000 contractual seller credit can be used under the final transaction structure. Can Sarah simply tell escrow to give the remaining $2,000 directly to Carlos? Answer: no. Unused seller credit funds do not automatically become cash payable directly to the buyer. The contract language, lender requirements, applicable loan program rules, and settlement structure must be considered. Sarah should involve the lender, escrow professional, and broker as appropriate, rather than creating an undisclosed payment arrangement. 3. Why is a secret agreement for the seller to give the buyer money after closing particularly dangerous in a finance transaction? A concealed financial arrangement may cause the lender and settlement professionals to evaluate the transaction using incomplete or inaccurate information. Material concessions should be appropriately documented and disclosed. A licensee should never help the parties hide a financial arrangement from the lender in order to avoid underwriting or loan program requirements.